All right, I want to thank everybody for logging on to our webinar on financial wellness for graduating medical students. My name is Jay Weinberg, and I'm a financial planner. My practice is exclusively with physicians, and I've been in this line of work for over 20 years. In a given year, I lecture to well over 100 residency programs, fellowship programs, and many medical schools as well. And if you want to block out some time to discuss your specific situation, feel free to go to www.pgy1.com. We have a little questionnaire where it might take you a minute or two, and this will give us a global understanding of your situation, and then we can block out some time to talk. And if you want to go ahead, excuse me, and add me to the contact list of your cell phone or tablet, feel free to go ahead and scan the QR code in the bottom left-hand side of your screen. In today's webinar, we are going to talk about tax filing, student loan strategies, disability insurance, home ownership and mortgage options, life insurance, and Roth IRAs. And these are the topics that many graduating medical students need to address or should address sooner rather than later based upon order of priority. So I'm going to do my best to give you the tools to get a head start of a sound financial plan. So the first thing you want to be very cognizant of from a student loan standpoint is going to be filing your taxes as a fourth-year medical student. Now, you may not have an income, and chances are you probably don't have an income, but it is so important when you file your taxes as a fourth-year medical student because it makes the process of what they call a direct consolidation so much easier when you go to do that direct consolidation in just a couple of months or maybe sooner. So this year they have extended the tax deadline to April 15th, from April 15th, I should say, to the 17th of May. You don't need to wait till the 17th of May. The sooner you file your taxes, even if you have a zero income, even if your parents take you as a dependent, the better it is, because it takes the IRS, maybe a month or two to actually process your tax return. And you're going to want them to process your tax return so they have you in their system prior to you doing what they call a direct consolidation. And the direct consolidation is part 2 of the student loan strategy. So assuming you file your taxes, then what do? Well, you're going to do a direct consolidation. The time to do a direct consolidation is going to be after graduation and preferably before the beginning of residency. So most medical schools finish up somewhere in the middle of May, and most residency programs are going to start with orientation the third or fourth week in June, and then the official start date is typically the 1st of July. So you're going to want to be out of quote unquote student status, which I would tell you to mark your calendars for the first or second week in June to do your direct consolidation. And what your direct consolidation is, you're effectively taking all of your government loans that you borrowed periodically throughout medical school, and you're going to lump them into one big loan. And they're going to take a blended interest rate, so you're not losing if you do this direct consolidation, and it's going to make things from a record keeping aspect much easier, because it's easier to take control of one loan as opposed to 8 or 10 or 12 loans. And when you do your direct consolidation, this is going to quote unquote start the clock on public service loan forgiveness, if that happens to be the road that you're going down. And we're going to spend a decent amount of time over the next half hour, 45 minutes, talking about public service loan forgiveness. And when you do your direct consolidation, you're going to have the ability to pick your servicer. Oftentimes, people will choose Fed loan for that. And when you go through that process, they're going to give you some examples of payments. It's important to understand that these are mere examples and they are not what your actual payment will be. So don't get confused with that. I'm going to talk about in just a couple of minutes the two options that the lion's share of incoming residents are going to choose from an elections standpoint on your student loan. So like I said, mark it on your calendar for somewhere in the first or second week in June to do your direct consolidation and quote unquote start the clock for public service loan forgiveness. Where it stands right now is that we recently had an extension of the CARES Act, and they said for government direct loans, there's going to be zero interest and zero payments through the end of September. And just so you know, these payments are going to count as qualifying payments for the purposes of public service loan forgiveness. So that's all the more reason why you want to, quote unquote, engage these loans sometime after graduation, but before residency begins to get the clock going on public service loan forgiveness, because you're going to have a zero payment anyway. So why wouldn't you get the clock going? Now, there's going to be several factors that you're going to want to take into account, which are going to lay out what the best option is for you or strategy is for you on your student loan. So, are you hoping for public service loan forgiveness? What kind of loans do you have? Are they government direct loans? Might they be government loans that are not direct loans? Do you have interfamily loans, or could you have private loans, or a combination thereof? Marital status is a big one. Are you single? Are you married? Do you have dependents? If you are married, how much money does your spouse make? And do they also have government direct loans? Now, I did not list every possible election that the government gives you for loans. However, I did list the two here that the lion's share of incoming residents are going to choose from. And if I were to tag percentages to them, I would go out on a limb and say that probably 75% of incoming residents will be on Repay, and maybe 25% are going to be on regular PAYE. And we'll talk about the similarities, the differences, and where they make sense over the next few minutes. So the first option is what they call Repay, which stands for Revised Pay as You Earn. This is the newest of the income-driven options from the government, and this was rolled out in December of 2015. And with Repay, the payment amount is going to be 10% of your household income, regardless of tax filing status. And so I stress household income because if you are married and you happen to file your taxes separately, it doesn't matter for Repay. It is a payment amount of 10% of whatever your household income is, regardless of your tax filing status. Now, if you're single, it's a moot point. The best part about Repay is that there's a credit or a subsidy of 1/2 of your unpaid interest. And we have a dedicated slide for this in just a couple of minutes that we'll go through. One of the downsides to Repay, but it's oftentimes a moot point, is that there's no cap of the 10-year standard repayment for Repay. And what that simply means is when you're in attending, you likely don't want to be on Repay anymore. Repay is eligible for those of you that have direct loans, and it also counts towards public service loan forgiveness. The next option is PAYE, which stands for Pay as You Earn. The payment for PAYE, it's going to be 10% of your discretionary income. Now, what does that mean? So, if you are married, you have the ability to file your taxes separately and only pay based upon your income and your loan amount. If you are single, it's a moot point. Not everybody is eligible for PAYE. You have to be a quote unquote newer borrower. So if you had government loans prior to the fall of 2007, it may knock you out of eligibility for PAYE. PAYE does count towards public service loan forgiveness, and if you have direct loans, you're also eligible. And down here at the bottom, I wrote in something that's really important for everybody on here. You need to understand that your payment for these student loans, it's based upon whatever your previous year's income was. That is why it is so important for graduating medical students to likely file your taxes with a zero return, or with zero income, I should say, as an MS4, because that's going to set the stage for a zero payment when you're a PGY1. So let's go through some scenarios. If you are single and you have government direct loans less than, say, $100,000, and you have income of that of a resident or fellow, you're really not going to get it wrong no matter what you do. You could do PAYE or Repay, and if there's absolutely no chance you're going for public service loan forgiveness, you may want to entertain a private refinance. However, I said this before, and I'm going to say it several times throughout the body of this webinar. It likely doesn't make sense to do a private refinance now because we have zero interest and zero payments on government loans due to the CARES Act. And you can't get any better than zero interest and zero payments. So once the CARES Act is no longer in effect for student loans, maybe you take a look at a private refinance at that point in time. If you are single and you have more than $100,000 in government direct loans and you have income of that of a resident or fellow, Repay is going to likely be the best option for you. If you are married and your spouse does not have income or has very little income, and you have income of that of a resident or fellow, and you have more than $100,000 in government direct loans, you're going to want to be on Repay and likely file your taxes joint. If you are married and your spouse has comparable income and comparable loan amounts, both of you are going to want to be on Repay and likely file your taxes joint. The one-off scenario is that if you are married to somebody that has really good income and little or no government direct loans. And the reason I say this is the one-off scenario because as we discussed a couple of minutes ago, Repay takes into account household income. And if you're married to somebody making a lot of money, it's going to really drive up your monthly payment for Repay. So Repay for some is not a viable, or it's not a very good option if you're married to somebody that's making really good income or little or no loans, because you're going to have a really high payment, which may not be the best thing for you. So if that's the scenario, if you're going for public service loan forgiveness, you're going to likely want to be on PAYE and likely file your taxes separately. Or if you are not going for public service loan forgiveness, you may want to do a private refinance. And if you do that, you'll likely file your taxes joint. But once again, it likely does not make sense to do a private refinance on government loans while the interest rates are zero and the payments are zero, scheduled to go through the end of September. Public service loan forgiveness. I am sure that everybody has heard of this program. sometimes in a positive way and sometimes in a negative way. So let's map it out for you. In the fall of 2007, the government rolled out a program called Public Service Loan Forgiveness. They said if you have the right type of loans and you work at the right type of place and you make X amount of qualifying payments, you will be eligible for tax-free public service loan forgiveness. So what kind of loans count? Government direct loans. Not all government loans are direct loans. If you have Fell loans or Perkins loans, they are not direct loans. But when you do your direct consolidation, you can actually lump those loans into the direct consolidation and turn them into direct loans. You have to be working at the right type of place, which is going to be a government or a nonprofit 501c3 entity. The lion's share of residency programs do fit the bill for this. If you have any questions, I would suggest reaching out to your GME or to your upcoming GME, I should say, and ask them if they are a nonprofit 501c3 entity. Because if they are not, it can really impact the strategies that we take on your student loans. And finally, you have to make 120 qualifying payments. Qualifying payments are going to be IBR, pay as you earn, repay, 10-year standard. So if you do A, B, and C, you will set the stage for tax-free public service loan forgiveness. Couple of tidbits. Do not pay more than your minimum required payment if you are going for public service loan forgiveness. And there's two reasons for this. Number one, this is going to be tax-free of whatever the unpaid amount is on the back end. So why would you pay extra if they're going to forgive whatever's left? You're simply throwing money away or taking money out of your own pocket in doing so. Furthermore, if you pay extra or more than your minimum required payment, it puts you into something called paid ahead status, which confuses the calculation systems that these loan servicers use to calculate how many qualifying payments you've made. So simply pay whatever your minimum required payment is. Next, it is highly encouraged, although not mandatory, that you submit your certification forms annually. And the reason I say this is because you may think that you're logging time. However, your loan servicer, for whatever reason it might be, they may not have you logging time. So the sooner you figure out that there's some type of a disconnect here, the sooner you can try to rectify the issue. Don't wait until you're 3 or 5 or 7 years into your training to submit your certification form. You should do it annually. And then if there's a problem, you can try to rectify it sooner rather than later and make sure that things are going to count on a going forward basis. So there's going to be many scenarios where repay makes sense for residents, especially single residents. So let's go through an example of how repay works. And once again, I know I've said this before, but through the end of September, there's zero interest and zero payments on loans. So this really wouldn't kick in until the CARES Act modifications are lifted. But needless to say, when you do your direct consolidation, you're going to pick a repayment option, and that's when you're going to quote unquote engage these loans. So basic example here. Let's say you have $200,000 in government direct loans, which are likely somewhere around 6%. So that'll get you $12,000 a year of interest. Let's say your payment's going to be $250 a month, which will be a $3,000 annual payment. So if you got $12,000 of interest and you're paying $3,000, that's going to leave $9,000 of unpaid interest. With repay, there's a subsidy or a credit of 1/2 of your unpaid interest amount. So in this case, that subsidy or credit will be $4,500. So rather than your loans growing from say 200,000 up to 209,000, they're going to grow from 200,000 up to 204,500. So if you can get 3 or 4 or 5 good years out of Repay with that subsidy, that could be 20 or 30 or 40 or $50,000 that you don't have to pay back because you had that amount subsidized or credited for the unpaid interest. So when you choose your election in just a couple of months, if not sooner, make sure you choose the plan that is going to make the most sense for you. Don't just blindly pick any of them, which I can't tell you how many times I come across people that are in the body of their residency, and they chose something because they thought it was going to be the lowest payment option, when in fact it was simply a very confusing or misleading example that they gave you when you were doing your direct consolidation. And I noted that when we were going through that direct consolidation slide. Don't get caught up with the examples because they are mere examples. They are not for your specific situation. Where does a private refinance make sense? So I cannot say it enough. If there is any chance you are going for public service loan forgiveness, you do not want to do a private refinance on government direct loans, because once you take loans away from the government, you can't put them back at the government, and you are giving up the ability for public service loan forgiveness. You need to have a good credit score. If Repay is not a favorable option, if you have high interest rate government loans, and a scenario where it would make sense sooner rather than later to entertain a private refinance is if you have high interest rate or high payment amounts on private loans. Private refinances are a terrific opportunity for those right this minute that have private loans. And we are at historic lows for the interest rates on these private refinances. So it may be a terrific time for you to take a look at a private refinance. And there's two companies that have terrific options for private refinances for residents and fellows. And those two companies are going to be SoFi and Laurel Road. Both of them have programs that allow you to pay $100 per month while you're in your training years, and they give you a 6-month grace period on the back end of your training years. And it's not until you are 7 months after graduation from training that your quote unquote normal payment will kick in on your loans. Feel free to go ahead and scan these QRs or jot down these URLs if you want to make yourself eligible for either a lower interest rate or a cashback welcome bonus if you engage a private refinance with one of these respective companies. And there's many companies in the private refinance arena. However, for residents and fellows, these are the two that have a terrific program. The next topic we're going to get into is disability insurance. And this is my specialty. In a given year, I'll lecture to over 100 residency programs, fellowship programs, and medical schools about disability insurance. And last year, we were rather busy. We had over 500 physicians utilize our services to secure individual disability insurance policies. And if you would like to block out some time to discuss disability insurance, feel free to go ahead and complete our questionnaire, which I'll have a link to in just a couple of minutes, but feel free to go ahead and complete our questionnaire at www.pgy1.com. It'll take a minute or two to complete the questionnaire, and then we can talk about your specific situation. So the first thing you want to be extremely cognizant of within a individual disability insurance policy is what they call own occupation. Think of this as the litmus test that insurance companies used to say, if God forbid something were to happen to you, would you be able or eligible to collect on the policy? If I were to show you 5 different policies from 5 different companies, they are all going to have different wording for own occupation. It is not a one size fits all. It's not like a gallon of gas where it really doesn't matter what station you get it from. It's going to get your car from point A to point B. Own occupation is specific to the company and specific to the policy. And there's very, very, very few policies that have very high levels for own occupation. The most favorable definition for own occupation, especially for physicians, is what they refer to as medical specialty specific true own occupation. And I'll give you an example of this. Let's say you are a hands-on physician, or let's say you are in a surgery-based field. If you can't do your hands-on procedures, or you cannot do your surgical procedures, you would be able to collect in full on the policy, even if you stay in medicine or if you do something totally outside of the scope of medicine. So if you can't do whatever your skill set is of your medical specialty, you would be able to collect in full, even if you stay within medicine or you do something totally outside of the scope of medicine. And there's very few policies that have this highest level of own occupation. Down here at the bottom is what they refer to as any gainful occupation. And this is actually not even own occupation. And we oftentimes see any gainful occupation wording within group disability insurance policies that are provided by your employer, or sometimes they are provided by a specific association that you may be affiliated with. And when they say any gainful occupation, here's how it reads. If you have the ability to perform the duties of any gainful occupation, you would not be eligible to collect on this policy. In 21 years in this business, I've yet to meet a physician that was comfortable with this wording. However, I can't tell you how many times we see this any gainful occupation wording in group disability insurance policies provided by employers. And the reason we see it there is because when you go to work for an institution and there's 1,000 other people that also work at that institution, they know that they're bringing on the good, the bad, and the unhealthy. And in doing so, they make it really, really hard to collect on that policy, because the way that they curtail their risk is by making it hard to collect on the policy. Whereas with individual policies, these insurance companies, they know who they're aligning themselves with. And in return, they have the ability to offer stronger policies with better wording. So all the more reason why you're going to want to have an individual policy that sits in first position. And then if they give you a group policy, have it layer behind the individual policy. While we're talking about group insurance, let's talk about some of the differences between group policies and individual policies. Taxation. Typically, group policies are going to be taxable if you need to collect on them. Whereas individual policies, you're going to pay for them with after tax dollars. And if God forbid you need to collect, the money comes in tax free. Portability. With a group policy, if you change jobs or employers, the policy typically stays behind. Whereas individual policies, you own them. That is your policy. You're going to put it in your pocket and you're going to bring it with you from job A to job B to job C, regardless of where you are, regardless of what you're doing. Contract language. I had alluded to this on the previous page, but group policies are often scaled back in wording and features because they know that they're bringing on people that would not be otherwise eligible to answer the medical questions and secure their own policy. Whereas individual policies, they're going to likely ask you the medical questions and they know who they're aligning themselves with. And in return, they can offer a more robust policy. And coverage amounts, this really doesn't kick in until you are an attending physician. But just because a group policy says that they cover you for 50 or 60% of your income, that is not necessarily the truth. And here's why. Because they may say that they cover you for 50 or 60% of your income, but you're going to have to dig down deeper into that group policy and find out that there's a cap on the policy. So it might be 50% or 60% of your income with a cap of maybe $5,000 a month or a cap of $10,000 a month. And to add insult to injury, that benefit would be taxable, and the only way you could collect that amount is if you are essentially a quadriplegic, for example, because these group policies will likely have wording that says if you can perform the duties of any gainful occupation, you would not be eligible to collect. So all the more reason why you want to have an individual policy that sits in first position, and then if they give you a group policy, have it layer behind. There's different types of disability insurance policies. There's short-term policies, and then there's long-term policies. Short-term policies typically kick in when you're out of work for a week or two, and they may pay out benefits for 3 to 6 months. Long-term policies, they typically do not kick in until you're out of work for 3 to 6 months, and assuming you can trip the litmus test within that policy, they may pay out benefits until the age of 65, in some scenarios, age 67. Aside from own occupation, the other most important feature that medical students and residents need to be extremely cognizant of is what, in generic terms, I'm going to refer to as the balloon option. The balloon option is the ability to increase your coverage amount at a later date without having to answer any medical questions based upon whatever your health is today, not whatever your health is in the future. So everybody on this webinar knows what their health is today. Nobody on this webinar can tell me what their health is going to be in 3, 5, 10, 15 years from now. So if you're in favorable health now and you get a policy and they offer you this balloon option, you are effectively putting the insurance company on the hook to give you more coverage later without having to answer any medical questions based upon whatever your health is today. This feature is worth its weight in gold. And just because a policy offers this feature does not mean that it is a very favorable feature. So the stronger policies allow you to utilize this balloon option every year. And if you don't want to do it one year, that's fine. You still have the ability to do it the next year. There's no mandatory requirements. There's no opt outs if you don't do certain things at certain points in time. So that's the favorable option. Then there's some companies and policies, they get real cute with it. And they bury it so deep into the policy that there's very little chance that you'll ever know about this until it's too late. And they say that every few years, it is mandatory that you submit a laundry list of paperwork. And then we're going to tell you how much you have to increase the policy by. And if you don't submit the paperwork, or you don't want to play by the rules, or you don't want to do a bump up, they view this as an opt out, and then you can never increase the policy again. So once again, just because an insurance company says that they have a balloon option, it doesn't mean that it's a good balloon option. And there is an epidemic out there going on with insurance professionals that uh, offer or sell policies with very rigid balloon options, and they do not disclose this to the consumer. This is a huge item, and I think it's so important for everybody to know that insurance pricing and wording is regulated on a state by state basis. And with most companies, it's the same in the lion's share of states, and then with most companies, it's going to be different in a few states. The four states where things are different with many of the insurance carriers are going to be Florida, California, Arizona, and Nevada. And just because the weather's so nice in these states doesn't mean that things are rosy for policies when you get them in these respective states. So 46 states, things pretty much the same. 4 states where things are different, not in a good way. And depending on the company, there are some other one-off states that may be a bit different one way or another. So if you recently matched into a program in one of these respective states and you're not in that respective state just yet, it would likely make sense for you to begin the process to get a policy prior to moving to that respective state. And then you're going to bring it with you, the policy that you got from the initial state, not the state that you were moving into. Now, on the flip side, let's say you are in one of these states now and you matched into a residency program that's not in one of these respective states. Maybe it makes sense to wait a month or two to get a policy, and maybe you're going to be able to get a stronger policy for less money, or a comparable policy for the same money or less money. But this is going to be on a specific situation basis. But if you did match into one of these states, I think it should be one of the light bulbs that goes off of things that you want to do prior to going there. Medical underwriting. When you go to get an individual disability insurance policy, typically the insurance companies are going to ask health questions. They want to know, what's your current health? Have you had any surgeries? What's in your family history? Do you have any pre-existing conditions? They also want to take a look at the pharmacy database to see what you've been prescribed. And many companies nowadays, they are waiving blood and urine when you get a policy as a medical student, resident, or fellow. So just be aware that they want to know what's going on with your health when they're going to give you a robust policy. From time to time, we'll come across what I would refer to as no medical questions asked disability policies, and there is a time and a place for these policies. And if you have a serious pre-existing condition that would really make it hard or impossible for you to get a comprehensive individual policy, that would be a terrific opportunity for you to take advantage of one of these policies. On the flip side, if you have little or nothing going on in your medical file, it would not be in your best interest to take advantage of one of these types of policies because they are oftentimes scaled back in wording, features, amounts, and sometimes they cost more money too. So don't get scared into taking one of these policies because you had a sinus infection a few years ago and got prescribed something. Now, with that said, if there's something serious in your chart, it would be a great opportunity. But with little or nothing going on in your file, there's likely going to be stronger options for you that would require you to answer the health questions. From a financial qualification standpoint, it's easy to get a policy when you're a graduating medical student or resident or a fellow. I'm not saying you can or should do this, but you can actually be covered for more money than you're making. Um, Now, you'll likely have the ability to secure as much as $5,000 per month of tax-free benefits. There are some scenarios where we do have people in your situation that get a $5,000 policy, but there's many scenarios where we do not get policies for the maximum amount. That's going to be specific to your situation, your needs, the medical specialty that you matched into, and whatever your earnings potential is. And I customize my policies for every one of my clients. There's no one size fits all for policies. I spend a tremendous amount of time with my clients understanding the situation and mapping out the options, the pros, the cons, the pushes, and the pulls, so you can get a policy that meets whatever your needs are now and will align with hopefully whatever your goals are in the future. And when you're on the back end of training, whether it be residency or fellowship, you can likely get a higher coverage amount, especially if you have an executed employment contract. The reasons why you want to look at a policy sooner rather than later. I always suggest to people to get a starter policy. And I can't tell you how many graduating medical students are in the process of getting policies through me now. It's a tremendous amount because right this minute, you know what your health is. And when you're in favorable health now and you get a policy, they're going to offer you that balloon option, which is going to allow you to increase your coverage amount later with no health questions asked. So that's really the main reason to get a policy sooner rather than later. And a lot of times people will, ask me what it's going to cost. And I don't know exactly what it's going to cost because once again, I customize this for every client based upon their needs, goals, and objectives. But from a pure budgeting standpoint, oftentimes policies for graduating medical students, they could be $50 a month up to $150 a month to get your foot in the door. So from a budgeting standpoint, just keep that in the back of your mind, somewhere between 50 and 150 a month to get a robust policy with the right features. Hopefully, which you'll then be able to adjust down the road when your needs change, when your income changes, when your job changes, whatever it may be. And many insurance companies offer a student or resident discount when you get a policy while you're in your training years. It's not a reason to get a policy. However, if you can save some money and get a discount on a policy that's going to stay on the policy for the next 20, 30, 40 years, it certainly helps. Some of the red flags that I've come across within the disability insurance arena, and I've been in this line of work for 21 years now, and I can spend an hour and a half talking about all of these four items, but I'm going to keep it to just a few minutes. And things have gotten, I don't want to say worse, but I'm seeing more and more red flags as the years go by, and there's a lot more now than there was 3, 5, or 10 years from now. So the first major thing that you want to stay away from, if an insurance professional shows you a one-page grid that maps out 6 different policies, you're going to want to start running fast and keep running far. And I say that because it takes an insurance company 40 or 50 or 60 pages to properly and accurately map out one policy. It is impossible for an insurance professional to properly and accurately map out 6 different policies on a one-page matrix. These grids are littered with incorrect or misleading information. Uh, I can't tell you how many times clients have brought these grids to me, and it's just amazing what some insurance professionals show to people. It's truly amazing. So if you see one of these grids, you probably want to engage the services of another insurance professional. Next, you do not want to work with what they call a captive insurance agent. That is an insurance professional that only represents one company. It's like trying to put a square peg in a round hole, hence the picture. Sometimes it's going to fit, other times it's not going to fit, but we're going to do our best to make it fit. You want to work with what they call an independent broker for insurance, which is what I am. I represent multiple companies with no ties or allegiance to any one specific company, because everyone's situation is different. Different people have different stuff going on with their health. And you really need to have options, especially when there's some health stuff going on in your file, because one company may say no to you, but then another company may say yes. So you need to have options. If the cost for a policy seems too good to be true, it likely is. Typically, policies they cost around the same. There's going to be some difference, but if you're looking at a policy that costs $40 a month, and then there's another one that costs 80, another one that costs 90, and another one that costs 100, there's going to be something going on with that policy that costs 40, because there should not be such a discrepancy in price. So you don't want to price shop for a policy, because you will likely end up with a policy that is scaled back in wording, features, amounts. And there's a million and one ways that you can tweak policies to bring the price down. And, I've seen all the games out there. Finally, the bottom one, which has come to the forefront more so over the past few years, there are several blogs or websites or forums out there that cater to those that are in the medical market. And these arenas are like flea markets for insurance producers. Just so you know, 99% of the time, all the insurance professionals are going to have access to the same policies from the same companies with the same price, because pricing is regulated on these policies. Now, Once in a while, there may be a special deal that a certain producer gets from from a certain insurance company, but 99% of the time, we all have access to the same stuff for the same price. So what these insurance producers do on these blogs or websites, they oftentimes scale back the wording or features within a policy to act as if they have the best price on said policy, which is not the case. What they're doing is simply tweaking the internal makings of the policy to act as if they have the best price, when in turn they're actually sacrificing the integrity of the policy to lead you to believe that they have a better price for said policy. I can't tell you how many times I've had people bring pricing models to me that they got from other agents, come to find out that these other agents knowingly uh, scaled back features from the policies to act as if they have the best price. So stay away from insurance professionals that advertise on these forums or blog websites. If anybody would like to block out time to discuss their specific situation with regard to disability insurance, feel free to complete our questionnaire at www.pgy1.com. This questionnaire will take a minute or two, and it will provide us with a global understanding of your situation. And then upon receipt, we can block out some time to talk. I do not charge fees to talk. Maybe you want to run a health situation off of me. Maybe you want to run a current policy that you may have off of me. Maybe you want to find out, what would a policy look like for me. I'm happy to do whatever I can for you. As I mentioned, disability insurance is my specialty, and last year we had around 500 physicians utilize our services to get individual policies. The next topic we're going to get into is home ownership and mortgage options for physicians. I am not a realtor, and I am not a mortgage broker, bank, or lender. Now, with that said, I think it's extremely important for physicians to know what types of mortgage options are out there and available to them now that they've matched. And I think it's important to weigh out the pros and cons of purchasing a place for residency or not. So what you want to take into account is, how many years is your training going to be? Did you match into a 3-year residency program? Or did you match into a 7-year residency program? Are you planning to do fellowship afterwards? And if you do fellowship, is there a lot of potential fellowship opportunities in the said city where you are going to be doing your residency? So think about how many years. Now, if you matched into, say, 7 years of neurosurgery, uh, it may make sense to purchase a place. If you matched into a 3-year family med or internal med or emergency med program in a geographical area where you're probably not going to stay in after your training years, it probably does not make sense to purchase a place. So I've heard people, they say, 5 years, you buy, 4 years, probably not, 3 years, probably not. I'm going to leave that up to you, but just be cognizant of, the cost of renting, the benefits of owning, the benefits of renting, and then make the decision for yourself. And you also have to take into account the geographical location. If you matched into a residency program in New York City or Miami or somewhere in California, it may not even be an option to buy because places cost so much money. Now, whereas, let's say you match into a program in Philadelphia or some places where it might be very affordable to buy a place. Well, now you have a decision to make. And now that you have a match letter, you would be eligible for what they call a physician mortgage. And once again, I am not a mortgage broker. I have no financial ties to any bank or lender that offers these products, but you need to know about them. So when the time comes to buy a place, whether it be in 3 months when you start residency, whether it be in 3 or 5 years when you're on the back end of your training and you want to settle down and be in a certain geographical area, you need to know what kinds of mortgages there are out there for you. So if you are an MD or a DO, or in your case, likely you have a match letter and you've not yet graduated, you would be eligible for a physician mortgage. And typically, physician mortgages, they allow for a very low or no down payment. The interest rates are going to be competitive. Sometimes I've seen them where they're a little bit lower. Sometimes I've seen them where they're a tad bit higher, but call it competitive. And there's something called PMI, which might as well be a four-letter word. This stands for private mortgage insurance. And this is a fee over and above the quote unquote regular cost of a mortgage. Now, if you end up getting a physician mortgage from a really favorable lender in the space, there's not going to be PMI. And that is a terrific thing because your PMI could be an extra $2, $3, $4, $500 a month. So if you don't need to have it, then don't. And like I said before, I have no financial ties with any lenders in the space. Now, with that said, if you want to send me an email, I'm I'm happy to let you know where you should be looking for these physician mortgages. So simply send me an email. Let me know what geographical area you matched into and what respective program you matched into, and then I'd be more than happy to let you know which lender or lenders you should likely consider for this physician mortgage if you're thinking about buying. The next topic is life insurance, which is also something that I specialize in addition to disability insurance. The time that you really want to consider getting a life insurance policy is if you're married, if you have dependents, if you have co-signers on loans. I'm not saying that if you don't trip any of these items that you should not get a policy. What I'm saying is, if you do trip any of the items, it should be a time where you really try to consider it and does it make sense? There's different types of policies out there. There's term life policies, and then there's permanent life policies, oftentimes referred to as whole life, but there's many different flavors within the permanent life insurance arena. So for the lion's share of graduating medical students, residents, and fellows, term life is going to be the most favorable option. And you can get term policies that last for 10, 20, 30, 40 years. Term life insurance is extremely cost effective. And you can buy a very large policy for not a lot of money. And I'm not giving you pricing for any one specific person on this webinar, but just so you have some type of rough estimate of what a policy would cost. Let's say you're 25 or 30 years old, you're very healthy, and you have a very favorable family history. If you want to get $1 million of, say, 20-year term life insurance, maybe it's going to cost you $300 per year, which would be a fixed price for the next 20 years. So, maybe $300 a year to lock in $1 million of 20-year term life insurance. So just keep that in the back of your mind. maybe you have dependents or you own a place or you have co-signers on your loans, it doesn't cost a lot of money to get a decent amount of life insurance. And on an individual basis, if this is something you would like to discuss, please do not hesitate to reach out. Roth IRAs, they are a terrific retirement planning vehicle to take advantage of when you are not making a lot of money now, however, have every intention of making really good money in the future. The way a Roth IRA works is that you fund them with after tax dollars. The money is going to grow free of any tax. And then on the back end, when you pull the money out, when you're, say, 60 or 70 or 80 years old, the money comes out tax free. So after tax in grows without any tax and comes out tax free on the back end. Your eligibility for a Roth IRA has to do with your income and tax filing status. So I am going to give you the IRS rules or limits for tax year of 2021. Now, keep in mind that if you have not yet filed your taxes for 2020, you may still be able to get money in, once again, depending on your income and tax filing status for the year of 2020, because you have until the sooner of tax filing, or in this year's case, now that they've extended it, the May 17th is the tax filing deadline for tax year 2020. But I'm going to give you the rules for 2021. So if you are single and making less than $125,000, you have the ability to get as much as $6,000 into a Roth IRA, or any amount less for that matter. If you are married and you file your taxes joint and you have less than 198,000 of income, so married, file your taxes joint with less than 198,000 of income, both you and your spouse will have the ability, respectively, to each get as much as $6,000 into a Roth IRA. The one that throws people for a loop is that if you are married and you file your taxes separately and you have more than $10,000 of income, you are not able or eligible to get money into a Roth IRA in the quote unquote normal fashion. I am not saying that there may not be, excuse me, a way around that. But if you are married, filing your taxes separately with more than $10,000 of income, you are not able to get money into a Roth IRA. And keep in mind, you need to have earned income to get money into a Roth IRA as well. In this webinar, we talked about 5 different topics: student loans, Roth IRAs, disability insurance, life insurance, and home ownership. I would encourage everybody to prioritize these items 1, 2, 3, 4, and 5, and then peck away at the list based upon priority of your rank. I'm not saying that you shouldn't do a Roth IRA, because a Roth IRA is a terrific retirement planning vehicle. However, if Roth IRA is 3 or 4 on that priority list and you have not yet addressed 1, 2, and 3, maybe you want to address 1, 2, and 3 prior to doing number 4. Now, everybody has a different priority list, and everyone has a different situation. But you simply need to map this out for yourself. And the sooner you do this, the sooner you will lay the foundation for a sound financial plan throughout your residency, fellowship, and attending physician years. I want to thank everybody for logging on. And what I'm going to do is I'm going to give everybody a chance to go ahead and scan these QR codes if you like. And then in just a couple of seconds, I'm going to stop recording the webinar and then open it up for questions. So whoever wants to ask questions, feel free to go onto the control panel and type in your questions. I will do my best to answer them. And also, whoever registered for this webinar, I will be emailing over a copy of the webinar in the next few days. You are welcome to share the webinar with your respective medical school, with those of you that matched into your program at whatever residency program, wherever you want to share it, you're welcome to. Hopefully everybody was able to pick up some information that they uh, may not have known just yet. And I want to thank you for doing what you do. We've had a kind of crazy past year, and I envy you for going into this field. And I just want to say thank you. So hopefully you picked up some good information. I'm going to stop recording now. I'm going to give it a minute or two for everybody to type in whatever respective questions they have, and then I will, like I said, pass along a recording of this webinar to everybody that signed up. So have a great day.